Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we have a webinar that I think is very critical to many investors' better understanding of options trading, which is options trading provides you many times with leverage. So we want to talk about how we can utilize that leverage to our advantage. More importantly, when we usually talk about leverage, we think of that as a double-edged sword. It works in your favor when you get the direction right, but it can really hurt your portfolio if you get the direction wrong. So we want to talk about how we can increase your leverage using options, but do so in a way with limited risk. And then what we want to talk about is how you can take advantage of the multiple use of multi-leg options to really extend this even further and increase your leverage even further with actually even smaller risk. And this is really where you can get creative with options. So for those of you that did take our beginners course from last month, we did talk about, the 4 fundamental building blocks of option strategies, which are buying calls, buying puts, selling calls, and selling puts. Once you understand those fundamental building blocks, now we can start utilizing them and start building strategies that really allow us to provide these types of highly leveraged but very low risk type strategies using options. So let's go ahead and get started. A lot to cover, but today what we want to do is try to use as many examples as possible, using real examples to give you a better understanding as to how to utilize this, especially as we start to see the momentum in the market start to shift a little. We want to talk about how we can take advantage of that shift in momentum utilizing options. So all the things that we're going to go over here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So a bit of housekeeping. For those of you that are brand new to OptionsPlay, if you have not already registered for a free trial to get access to everything that I'm going to show you here today, such as the platform, the weekly research that we send out, and the daily trade ideas, you can register for a free trial at OptionsPlay.com, which I will post into the chat window. And we still have a pretty action-packed schedule here for the rest of the month. So if you sign up for a free trial, you'll automatically be registered to attend those sessions. But next Tuesday, I have Tom Sosnoff back with me. We're going to be doing a live analysis using Tasty Works together. I think it's going to be a great time together because there's a lot of volatility in markets. I think we're going to have a lot of opportunities. So really looking forward to doing that session here with Tom. So many attendees here last time I had Tom on, we actually exceeded our webinar capacity. So we did add capacity this month so that we can make sure everyone can attend. So please make sure that you register for that. You can register using trade.optionsplay.com/learn, which if you're already registered for this particular session, you will have access to that as well next Tuesday. So really looking forward to that. Next Thursday, I think this is going to be one of the most important topics for anyone here who's trading options here today, which is trading psychology and the psychology that you need to be in order to be profitable, because many investors struggle with trading in general, where there is this reoccurring theme that as the last 15 years of working as a strategist, I've seen investors predominantly have a bunch of small winners, a bunch of small losers, and then they have a few large losers in their account that kind of blow up their trading accounts. So I want to talk a little bit about how to prevent that from a psychological perspective. So that's what we're going to cover next Thursday. So action-packed next week. Tom Sosnoff on Tuesday, trading psychology on Thursday, and then the following week we're going to do another live market analysis with Q&A. So a lot coming up here for the rest of September. So I hope that you're able to join us here. And also, since there's a lot of volatility here in the markets recently, want to make sure that we keep you updated as far as how we're seeing momentum shift here in this market, what we're expecting here. You can sign up using trade.optionsplay.com/weekly, which I will also post into the chat windows. That's tomorrow morning at 9 a.m. So I hope you're able to join us for those of you trying to figure out how to navigate these markets. So let's go ahead and get started. Today, what we're going to cover, first of all, is just a basic understanding of stocks versus options. It's really important to understand what you're getting, what type of exposure are you getting when you're trading stocks, and how does that compare to the exposure that you're getting when you're trading options. And we're going to talk about basic strategies of buying calls calls and puts first, because that's how we first learn about the leverage aspect that we get with options that comes with the limited risk. But there are some challenges to buying calls or puts, is the fact that the amount that you pay for that call or put many times is quite expensive. So that's why we want to be a little bit more creative, and we want to talk about how you can combine buying and selling calls and buying and selling puts together to do a more advanced strategy, which is a debit vertical spread. That's what we're going to talk about here today. That's going to really increase your leverage while decreasing your risk. And in both of these cases, we're going to try to go through as many examples as possible using real symbols to teach you what we're going to go over here today. We're also going to try to spend a few minutes talking about the option Greeks if we have some time before we open this up for Q&A here at the very end. So let's go ahead and get started. But the primary thing that I want everyone to be able to walk away from here today is a basic understanding as to how options can provide you with leverage, but do so in a way with limited risk at the exact same time. So that's what we're going to go over here today. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I'm going to share with you my insights into how I leverage options to give me leverage in the directional views that I have in the markets, but do so in a way with limited risk. So let's first start off with stock trading. How many of you here are equity investors? Please type 1 into the chat window if you currently trade stocks in your portfolio. Okay, I see a ton of ones. So almost every single one of you seemingly have some kind of exposure to stocks in your or ETFs in your portfolio. So when we talk about stock trading, there's only one type of exposure that you get, which is bullish or bearish exposure. That's the only two exposures that you have when you buy or sell an underlying stock. Now, what does having bullish or bearish exposure really mean? It actually means that you get immediate gains if you get the direction correct, meaning if you buy a stock and the stock goes up, even by a penny, you start making money. On the flip side, if it goes down by even a penny, you start losing money. And you have symmetrical exposure, meaning if the stock goes from 100 to 110, you'll make $10. If it goes from 100 to 90, you lose $10. It's equal as far as how much money you make or lose depending on the stock goes up or down by that amount. So symmetrical exposure. It's really easy to understand. However, what you don't have is any time exposure, meaning if the stock goes from 100 to 110 in a few minutes versus it takes a day or a month or maybe even a year, no matter how long it takes, you make the same amount of profits. You make $10 profit if the stock goes from 100 to 110, regardless of how much time it takes. There's only one limitation when you trade stocks. It's the fact that you have no neutral options. So if you think a stock's going to trade sideways, you think it's going to go a little higher, a little lower, but you think it's going to end up in the same place a month from now, there's no way for you to make money on that specific trade. So that's what you get when you're trading stocks. So what do you get when you're trading options? It's a little different because you're not only are you getting exposure to the directional view, you're also getting exposure to time. You're also getting exposure to leverage. There's a few other factors at play. So today what we want to do is we want to break down those other factors to give you a better understanding as to what you're actually getting when you're trading options. Now, another question I want to quickly ask is, how many of you are brand new to options trading? Please type yes into the chat window if you're new and you're learning, and please type no if you have some experience or if you've already traded options in your account. Okay, so I see mostly no's, but I see quite a few yeses as well. Okay, so for those of you that are brand new to options trading, this is designed to hopefully help you inspire you to take a look at options as an asset class to help you take a directional view, but do so in a way with limited risk. For those of you that have experience trading, I hope that this is a lesson in helping you better understand the strategies that you're actually trading in your accounts. So let's talk about stock XYZ trading at $100. And I think the stock is going to go higher, right? So normally as a stock investor, what would I do? I would buy the stock and hope and wait for the stock to go higher. But when I'm an options investor, I can't just go out there and buy a call option because I think it's going to go higher. Because as we learned in our session from last month, when you buy a call option, it's not just bullish exposure, it's bullish by a certain amount. And that amount is driven by how much that call option costs to begin with. Because if I buy a $100 call option when the stock is trading at $100, which is a bullish strategy, let's say I pay $4 for that call option. how far how far does the stock need to move in order for me to be profitable on this particular trade? If anyone has the answer to that question, please type it into the chat window. What is my break-even price? That's correct, exactly, 104. Meaning when I buy a call option that costs $4, not only do I have to believe the stock is going to just go higher, I have to believe it's going to go higher by a certain amount. It has to go above $104 by my expiration date in order for it to make sense for me to buy this call option. So not only do I have to believe this stock is going to go higher, I have to believe it's going to go to 104 or more. So meaning I have to think it's going to go to 105, 106, 107, at some point maybe 110. So if I believe the stock's going to go to 110, doesn't it make sense for me to buy a call option? It absolutely does, because at 110, I'm going to be able to make a profit. I've exceeded the break-even price of this option. Now, what this allows me to do when I buy a call option is the fact that I'm able to control a $100 stock in exchange for just $4. Normally, to buy 100 shares of the stock, it would cost me $10,000 to buy 100 shares of the stock. But when I buy a call option, for each share costing me $4, this whole call option only cost me $400. So I'm controlling a $10,000 stock position for just $400. That means that I'm risking only 4% of the underlying stock price. That's the benefit of buying a call option, is that the risk that I take on this trade is that I'm only risking 4%, because I think the stock's going to go higher, but what if I'm wrong? What if the stock goes down to 90 or 80 or 70 or goes to zero? How much money do I have at risk? When I buy the stock, the further the stock declines, the more risk that I have. When I buy a call option, I'm only risking that $4 a share. That's the flip side that I have, or that's the trade-off that you're making with a call option, is the fact that you have unlimited upside. If the trade goes in your favor, the further the stock goes higher, the more money you make. But at the same token, if I'm wrong, I'm only risking 4% or $4 on this particular trade. The only trade-off here is that the stock needs to get above 104 in order for this strategy to be profitable. So once you add this element of the fact that the stock needs to be above 104, that changes the game completely, because you're not just looking at a chart and saying, I think the stock's going to go higher, let me buy a call option. You're looking at that chart, and then you're going back to, how much does that call option cost? In this particular case, it cost $4. So you have to ask yourself, do I think the stock's going to go above 104 by the expiration date? And at that point, you have to ask yourself, well, okay, if I think the stock's going to go from 100 to 110 and the call option cost me $4, then how much money can I make on this strategy if the stock does go from 100 to 110? If anyone has the answer, please type that into the chat window. How much money do I make on this strategy if the stock goes from 100 to 110 if I paid $4 for that trade? Exactly $6 per share, or basically $600 in terms of profit on this particular trade if the stock rallies to 110. Now that is $600 profit on a $400 risk. So normally if the stock goes from 100 to 110, how big of a return is that on the underlying stock? That's a 10% return if the stock goes from 100 to 110. But if you can see here, when I'm risking $400 to potentially make $600, how big of a return is that? It's 150% return. That is the leverage that you're getting from trading options versus trading stocks. If you bought the stock, you're looking at a 10% return. If you bought the option, you're looking at 150% return. And the benefit here is that if you're wrong and the stock, if you're wrong and the stock declines instead, if instead of going higher, it moves lower, how much do you risk? Here in the options trade, you're only risking $400. That's the limited risk factor that you have. When you buy a stock, there's no limit as to how much money you can lose. The most you can lose all $100 a share. So if the stock keeps going lower and lower and lower, if it goes to 90, 80, 70, the further it goes, the more money you have at risk. So that's the leverage piece that we're talking about with respect to limited risk. Does that make sense, everyone? Please type 2 into the chat window if this leverage aspect with the limited risk part makes sense to you. Okay, so everyone, I see a lot of 2s. So the last part that I want to make sure everyone understands before we move on to the next piece is the fact that The challenge here is, I mean, everything that I just showed you sounds great, right? But the challenge is, how often do you have a view where you believe the stock is going to go to 110? Sometimes you might think the stock's going to go to 105 or maybe 106, and maybe the risk reward ratio doesn't look so attractive, because if you think the stock's going to go to 105, then I'm only making $100 for my $400 risk. That's not a whole lot of potential return, because the difference here is the fact that if the stock stays flat, the stock doesn't move, how much do I make on this particular trade if I traded the option? If the stock goes sideways, how much do I make or lose on this particular trade? The answer is I actually lose $400 exactly, right? So if the stock doesn't move, I'm still losing money. That's the challenge when you're trading options. And it's not always easy to find stocks that you think is going to make a 4% move to the upside in order for it to be profitable. So what can I do as an options investor to hopefully help me improve this a little bit? That's really where we turn to call debit spreads. So a debit spread is really just taking a combination of what we learned in the first step, which is the 4 core strategies, and combining 2 of them together to give us a better payoff ratio. So I'm going to do the same example. I have stock XYZ trading at $100 that I think is going to go higher. Maybe I think it's going to go to 110 for argument's sake, right? So before, we talked about how if I bought a $100 call option and it cost me $4, what that general risk reward looks like, what type of leverage do I have, how much risk do I have. So now let's get a little bit creative, right? I think it's going to go to 110. But when I buy a $100 call option, what are you doing? You're paying for unlimited upside. When you buy a call option, you're basically saying, I think this stock can potentially go to infinity, and you're paying for it. That's the $4 you're paying for. But guess what? You don't have to pay for all of that. You can actually sell off some of that upside. And that's really where options can get really creative, where you can do lots of different things and create payoff graphs based on where you actually expect the stock to go. So in this particular case, what I can do is I can sell a 110 call. Remember, when we sell a call option, we're basically defending a level. We're basically saying we don't think the stock's going to go above a certain level, and you get paid if the stock stays at that level or stays below that level. So for those of you that are new to options trading, I highly recommend you to watch the recording on buying versus selling options, where we break down these strategies. But when you sell a call option, you're basically saying, I think the stock's going to stay below that strike price, and you get paid that $1 credit as long as the stock stays below 110. So in this particular case, what you're doing is you're buying that $100 call option that gives you unlimited upside, and then what you're doing is you're selling off some of that upside above 110 in exchange taking $1 in. So now, instead of risking $4 on the trade, you're only risking $3 on the trade. And when you risk only $3 on the trade, what happens is you also reduce your break-even cost. Before, I needed the stock to get above 104 in order to be profitable. That had to be 104. Now, because I've reduced my risk from 104 to 103, my max risk, my break-even price is now 103. So my max risk here is only 3% of the underlying stock price. So even if the stock drops to $97 or lower, I will not have any further losses on this particular trade versus if I had bought the stock. Does that make sense, everyone? Please type 3 into the chat whether this makes sense to you. And what this does is that, number one, it reduces my risk. Before, I was risking $400 on that trade. That my first trade, I was risking $400 if I just bought the call option. Now, what I'm doing is I'm reducing my risk down to just $300. So I'm reducing my risk by $100 on the trade. That is the decrease in risk that I'm taking. But what that also does is it increases my leverage, because now I'm only risking $300 on the trade. If the stock goes from 100 to 110, how much money do I now make on my vertical spread? If anyone has the answer, please type it into the chat window here. So in the exact same scenario, exactly $700. So what I'm now doing is I'm risking $300, but if the stock rallies up to that 110 level, instead of risking $400 to make $600, Now I'm only risking $300 to make $700. We're talking about the exact same scenario. So in the case of the stock, if the stock goes from 100 to 110, I'm looking at a 10% return on the underlying stock. Now, if we talk about a $700 return on a $300 investment, that turns into a 233% return on my investment. So now what I've done, as you can see, I've increased my leverage, and at the same time, I've decreased my risk. In reality, what I'm doing is I'm actually just increasing my leverage because of the fact that I'm able to reduce my risk. So whenever you're able to reduce your risk and do so in a way like this fashion, in this particular fashion, that allows you to increase your leverage and at the same time decreasing your risk. But the trade-off here is that you're trading off unlimited gains. So if instead, so I think the stock's going to go to 110, but what if the stock exceeds that 110? What if it goes to 115? Right? What if it exceeds my targets and goes all the way up to 115? Your max reward here is going to be capped at 7, meaning no matter what happens, even if the stock goes to 120, 130, 140, the most you can make is that 233% return on this trade. So if you really hit it out of the park here as far as this particular stock analysis goes, you will cap your gains here at that 233% return. So that's what you're giving up to have lower risk, higher leverage, is the potential of further gains if the stock really knocks it out of the park. Does that make sense to you? Please type 4 into the chat window if that makes sense to you. Okay, perfect. Now, before I move on, I actually want to jump over to OptionsPlay and show you some real examples, because I think the best way to learn, especially for those of you that are new, is to use a real example to try to show you. So let's take a look at Apple for 1 second. Now, regardless of what your views are here for Apple, I want to take a look at this pretending, and again, this is purely for education and demonstration purposes. This is not an actual view that I have on Apple per se, but let's say you felt that the recent sell-off here in Apple was a great opportunity to get back into this stock, and you think it's going to rally back up to 135, 133, somewhere in that range back to its 52-week high. So OptionsPlay, as you can see, when you first log in, you can click on either I'm bullish or I'm bearish. Will automatically show you 3 strategies. So what you'll always notice when you click on I'm bullish is buying the stock. That's the first strategy that we're talking about. We talked about buying a call option. This is the simple option strategy that you would take. And then we have a call vertical. That's debit spread that I was talking about. Not only does OptionsPlay present these 3 strategies for you side by side automatically, we also select the expiration date, the strike price based on best practices that we have back tested on these types of strategies, so that you don't necessarily have to know exactly how to construct these strategies from the ground up. You already have a starting point that you can utilize to start analyzing and learn more about it. If you have a little bit more experience and you want to make modifications to this, you can. If you want to change it to the November expiration, you can easily do that using the click of a mouse, but this is all done for you as a starting point to give you a comparison. To buy 100 shares of Apple costs you $11,000. To buy a call option will cost you $745. To buy a call spread will cost you $683. So let's take a look at the P&L analysis of this type of strategy. Now, I always advocate for anyone who's starting out with options, never look at how much money you can make on a trade first. Always look at how much money can you lose. That's always the first step, because if you can't take on the max risk of a trade, you shouldn't be in that trade to begin with. So let's just say, what if I'm wrong on my bullish analysis on Apple? What if, because at the end of the day, probably at least 40% of your trades you're going to be wrong on. That's the reality of trading. A lot of investors try to win 90% of the time. The reality is that doesn't happen. You're going to have losing trades, and it's better that you plan for it ahead of time rather than after you've entered the trade and you're in a losing position. You're trying to figure out how to get yourself out of a hole. Plan for it ahead of time. So what if I'm dead wrong on Apple and Apple gets back into that $100 range? Let's take a look. If I bought 100 shares of the stock, I would be down roughly $1,300 on this particular trade. Am I comfortable taking on $1,300 risk? That's a question for yourself depending on the size of your portfolio. If you bought a call option, you're looking at about $745 loss on this particular trade. If you bought a call spread, you're looking at $683 loss on this particular trade. Now, this is for one contract. You can use our risk and investment calculator and actually enter the amount that you're willing to risk. So let's say you're willing to risk $2,500. Maybe you have, a $150,000 portfolio or $200,000 portfolio, and you're trying to risk 1 to 2% of your account. So you say, okay, I'm willing to risk $2,500 on this trade. You can use our risk and investment calculator. It will actually calculate these two for you, the number of appropriate contracts, so that you stay within your risk limits here. So here, when I buy a call option here, it'll cost me $2,200. To buy a call spread, it'll cost me $2,049 here. So what I want to do is I want to compare, okay, if this trade goes against me, am I comfortable taking on a $2,200 loss or a $2,000 loss? The answer to that question should be yes before you do any further analysis or even consider this trade. If the answer to that question is no, I'm not comfortable taking on that risk. If I lost $2,000, it would not be good for my portfolio. I wouldn't be able to pay my bills or wouldn't be able to do something. You should never get into this trade to begin with. So always look at what the risk is first. If you're comfortable with the risk, meaning if you're comfortable potentially losing 100% of what you invested in that particular trade, then let's start taking a look at what is the potential upside. So let's say Apple does get a big move here very quickly here. Let's say Apple gets some good news over the next few days and makes a big move here to the upside. You can quickly see how each one of these strategies perform depending on how long it takes for that stock to make that move. So let's say Apple gets up to that 133, roughly 133, just into that range here. How does that look? If you had bought if you had bought the call option, you're looking at 141% return. If you bought the call spread, you're looking at 192% return. This is at expiration. So this is really where you can see, by reducing your risk from $2,200 down to $2,000, what you're doing is you're increasing your leverage on this particular trade. And as you can see, there's a substantial difference in terms of the potential profits you can make. You're looking at 141% return versus 192% return. That's a big difference, okay? And the other thing is that your break-even price on the call option here is 122. So the stock needs to get above 122 just to break even, versus the call spread, you only have to get above 119.83 in order for this strategy to be profitable. The stock has to move $3 less in order for you to be profitable. Here, the stock has to move about $6 in order for you to be profitable. Here, the stock needs to move almost $10 for the strategy to be profitable. Those are two very, very different strategies, two very different outlooks that you might have on an underlying stock. Now, you might also say, well, I think the stock's going to make a big move in a very short amount of time. Maybe you think it's going to make a big move. Today is the 10th. Maybe you think by the 24th, in 2 weeks' time, the stock's going to be back up at 133. You think it's going to be a big, quick move. That's where you can also use the P&L simulator. And this is something we're going to talk about in terms of the Greeks as to why, when you buy a call option, if you're expecting a big and fast move, you might be better off buying the call option rather than the vertical spread here. So this tool, the P&L simulator, is extremely powerful. It allows you to simulate any different type of outlook you might have on the underlying stock. It allows you to quickly get a sense for what your potential reward is, but at the same time also what your potential risk is if the trade goes against you. This is all designed from the ground up to try to make this process as easy as possible so that you understand what your potential risks and rewards are before you get into a trade. I cannot speak enough of how many investors that I have heard, especially beginners, who buy a call option because they're bullish. They didn't really look at how much the call option cost. They didn't really know how much they were risking. Next thing they know, sometimes the trade goes in their favor and they still lose money because they didn't understand the concept of break-even prices. They didn't understand the concept of time decay. We've created this P&L simulator so that you can fully understand your strategy before you get in, so that nothing surprises you after you get into the trade. There's nothing worse than getting into a trade afterwards and then finding out it's not going to work out the way that you had expected to. Use the P&L simulator to help you better understand each strategy. So with that, let's jump back into put options, right? This is the bearish side. So let's say I have stock XYZ. Actually, before I start the put options piece, I just want to make sure everyone understands how to utilize OptionsPlay to type in a symbol. Quickly look at 3 strategies, whether you're bullish or bearish. We're going to look at bearish strategies next, how we display the strategies to you, and how you can use the P&L simulator to simulate what your expected risk could potentially be on a trade, and also at the same time what your potential reward is. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And I know there are some questions. I will make sure we come back to those questions here at the end. Okay, perfect. I just want to make sure everyone understands how to utilize the platform. And if you say kind of, that's okay. You know, that's why we record these, so that you can so that you can watch these at your own pace. We'll send you the slides so that you can have access to this and watch it at your own pace. So with that, let's cover bearish strategies, right? So in the markets, right now, you might have some more bearish opportunities or some more bearish views than you might have on bullish side. So let's take a look at how can we use options to take some bearish views. So let's say I have stock XYZ. I think the stock is going to drop instead of going higher. I think the stock is going to revisit that $90 low here on this particular stock. So what can I do? I can buy a $100 put option that cost me, let's say in this particular case, $4. The challenge with whenever you're buying a call or a put is the fact that you have to pay money to get into that contract. And whatever you pay, you have to overcome that move in the underlying stock in order for you to be profitable. So in this particular case, because you paid $4, your break-even price here is 96. So it requires a 4% move to the downside in order for you to break even. So what that means is that you have to actually believe the stock's going to go go lower by more than 4% in order for it to make sense for you to buy that put option. The further the stock goes, the more money you make. So you have unlimited gains to the downside. That's one of the benefits of buying a put option, is that you have unlimited gains. Technically, there is a limit because the stocks can't go below 0, but I usually think of the stock going from 100 to 0 as roughly unlimited gains, because you do have an expiration date. The chances of a stock going to 0 within that date is really slim. So that's why I call it unlimited. And you're only risking 4%. So even if the stock was to shoot significantly higher into the 120s and 130s, guess what? You're only risking 4% of the underlying stock price. You're not risking any more no matter how far the stock goes. That is the leverage that you get when you're buying a put option. So if the stock declines to, let's say, $90, what you're doing here is just like the previous example. Since each contract represents 100 shares, what I'm here is I'm risking $400. And if the stock was to drop that 10%, I make a $600 profit from my put option if the stock goes down to, let's say, $90. If I had shorted the stock, I'm looking at about a 10% return. But if I traded the option, I'm looking at, again, a roughly 150% return. While at the same time having this leverage, I'm only risking 4% of the underlying stock price. But the trade-off here, and a lot of investors would ask, why wouldn't everyone buy put options, right? Like, why would I ever want to risk $100 a share and potentially have myself exposed to unlimited risk and not have the leverage and not have the limited risk factor? And it really comes down to the fact that if the stock moves sideways, meaning if it doesn't move lower, it just moves sideways, or moves lower but a little bit, you still can lose money on this trade. That's the challenge when you're trading options, is that when you buy an option, the stock needs to make a big move to the downside just to break even. If it moves sideways or moves a little bit lower, you actually lose money on that trade. So that's the challenge that you have when you're buying a put option. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so now let's look at put vertical debit spreads, which is the exact same thing as before. If you understood what we talked about on call spreads, put spreads will make should make equal sense to you. What we're doing here is stock XYZ. I think it's going to go lower. So what I do is I buy a $100 put option. we talked about the challenges of buying a put option is that the stock needs to make a big move just for me to be profitable. How can I reduce that? Why should I pay for unlimited downside if I don't think the stock's actually going to go to zero? That's where we can get a little bit creative. We can sell a put option. So for those of you that learned from our previous session last month about buying versus selling options, when you sell a put option, you believe the stock's going to stay above that strike price. So if I sold the $90 put option, and let's say I collected $1 credit for it, what I've done is I've reduced my overall risk on the trade from $4 a share down to $3 a share. And what that does is it increases my leverage. It decreases my break-even price. So now my break-even price, instead of being $96, is only $97. So if the stock does make the move that I expected to, I get higher amounts of leverage. I get lower risk. I have a better probability of profit because there's a higher probability the stock's going to be below 97 than it's going to be below 96. The further the break-even is lower, the lower the probability of my success. So the goal here is to try to bring the break-even price as close to the current price as possible, because the closer the break-even price is to the stock, the higher probability that you have of making a profit on that trade. So the only trade-off that you're doing here when you're trading these debit spreads is the fact that you are giving away unlimited downside. So if the stock, instead of going down to 90, goes down to 80, right? Normally, if you had bought a put option, you'd participate in all of that. You're basically risking $1 more to potentially have access to unlimited downside. But the reality is that that doesn't happen very often, that you're far better off saving that $1 on every single trade, so that, you know, once in a while you do hit it out of the park. Usually that doesn't offset the savings that you make on every single trade when you use a debit spread. But what you're doing here is you're trading off some further downside in exchange for lower risk and higher leverage on that trade. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Let's do again another example here. I think this is a better way to learn. Let's look at Lockheed Martin here for 1 second. So Lockheed Martin today broke below 380, you know, a fairly major support level here. It closed at around 379.11. Maybe this is one of the stocks that you think might be potentially moving lower. Actually, this doesn't look particularly great. Let's look at another stock. Let's look at the Qs. Let's look at the NASDAQ 100 index. Chart looks very similar to Apple, so actually a good example here again. And this is not a reason to go short the markets. This is just using this purely as an example. If, let's say, I think that markets sold off, bounced a little, and now I think they're going to continue moving lower, maybe you want to buy a put option on the markets. So looking at the Qs, once I select I'm bearish, I can short 100 shares of the stock. It'll cost me roughly $27,000 in terms of a notional value. You might have a smaller margin requirement. Buying a put option cost me $13.62 versus buying a put spread cost me $945. So notice how I'm saving a substantial amount here. I'm risking, instead of $1,300, I'm only risking $945. And again, always, whenever you're looking at option strategies, don't look at how much money you can make first. Look at how much money can you risk. And always ask yourself, am I comfortable if I actually had to sustain a full loss here on this particular trade? Because that is always a reality of losing the investment that you make on an option strategy. So I cannot stress enough, always look at what happens if I'm wrong. What happens if markets bounce back to that $300 level and I lose my investment on the strategy? Am I comfortable with that? Am I comfortable risking $1,300 or $945? If the answer to that question is no, move on to the next stock. Don't look at this any further. It's not worth looking at if you're not willing to lose 100% of what you're investing, or looking and understanding what your risk is. If you are okay with that, meaning if you have a sizable account and you say taking a $900 loss is something that I can sustain and something I can move on from, then we can start taking a look at what is my upside. So what if, you know, so for those of you that joined us here on Tuesday mornings, we talked about 270 as a major line in the sand here for the Qs. That's where it reached to, bounced off. Maybe you think that now it's gonna decrease below 270, and to the downside, for those of you that joined us, we talked about this 250 level as a support level to the downside. So maybe you think the Qs can get down to about 250 to the downside. So as you can see here, if you had shorted 100 shares of that stock, you're looking at about an 8% return, which is not bad for a stock in just a month and a half of the stock going down 8.5%. That's not a bad return. But if you had bought a put option, you're looking at a 65% return. You're risking $1,300 to try to make roughly $888. That's 63% return. So that tells me these put options, make the break-even price a substantially lower here. It's 258. So, we talked about if the stock breaks below 270, it can get down to 250, but my break-even price is 258. So it basically has to get to the bottom of the range just for this strategy to even make any sense for me to trade. Because if I just think it's going to get somewhere in between that range, like 260, notice how here I'm actually losing money. And this is really the counterintuitive part about options trading, because the ETF's at 273. If the stock goes down to 260, you're certainly right on your bearish view. There's no doubt about that, but you're losing money on the put option. That is a tough pill to swallow, of buying a put option, having the market move in the direction that you expect to, and then losing money on that trade. This is, I would argue, probably the most counterintuitive and frustrating part about trading options for most beginners, is to get the direction right and still lose money on the trade. And if anyone can empathize with that, please type 7 into the chat window. If you've ever been in that position where you've bought a call or a put option, the market moved in the direction that you expected to, and then you lost money on that trade. So for those of you that said not yet, I hope that this is a lesson for you in terms of learning, because the P&L simulator is designed to hopefully help you prevent that, so that you have a better understanding as to what your expected return is on each individual trade here. So if the stock went down to 260, here, at the very least, the vertical spread, even though it's not a great return, at least still provides you with some profit. So if you do think conservatively the ETF's gonna get to 260, you're looking at a 32% return. If it does get down to your target down to 250s, you're looking at a 138% return. So we're talking about the exact same scenario here. Do you want to risk $1,300 to make 65% return, or would you rather risk $945 to make 138% return? I think the answer for most investors here is pretty clear, right? The only difference here is that what if you think the stock's going to make a big move to the downside in a short amount of time? Now, in this particular example, the debit spread here on the right still provides the better return, a 99% return versus only an 85% return. But as you can see, the two here is pretty similar in terms of the actual potential return here. But that's how you can use the P&L simulator to quickly determine which strategy is best suited for you. And if, let's say, you have a very large portfolio and you're just playing with one contract at a time, and you're trying to play with a much larger portfolio, and you're willing to risk $10,000 at a time, then you can use the risk and investment calculator. Click on that I'm willing to risk $10,000 on this trade, and we'll calculate for you that you can buy 7 contracts of the put option or 10 contracts of the vertical spread, and you can compare the two side by side, dollar for dollar, how much potential risk or reward you have. So before, in the example, if the stock does go down to 250 by October 23rd, here what you have is the exact same amount of risk, right? Roughly $9,500 between the two strategies. But as you can see, the vertical spread here is giving you almost double, a little bit more than double the potential profit here if you're risking the same amount across both strategies. So this is really how you can compare, using this tool to give you a better understanding as to how to place these trades, how to seek for opportunities, how to analyze them, and ultimately be able to understand your risk and rewards before you execute a strategy. And you can use this for any stock that you have in mind. Whether you're using our trade ideas and you're scanning for some bearish opportunities, or if you're using your watch list to look for some opportunities. So if you think that the energy market's going to go lower and you find some, some bearish stocks here in the energy market and you're trying to short it, use the OptionsPlay tool to help you find these opportunities. And then more importantly, let's look at, let's say, ConocoPhillips. Let's say you think energy is going to continue moving lower. You can use this tool to find some opportunities, and more importantly, utilize the trading tab to help you find the strategies, analyze the strategies, and making sure that you understand your risk and rewards. So that covers what I wanted to share with you here today. I hope that you guys find this useful in better understanding our platform, better understanding the strategies themselves. And at this point, what I'll do is I'll open this up for Q&A. But before I do, I just want to thank all of our members for supporting us and allowing us to continue to doing this every single week. Like I said, it allows us to continue to bring on guests like Tom Sosnoff here back to continue your education and helping you guys better understand, how you can utilize alternative platforms to execute these. So I'm really excited to partner with Tom with Tastyworks, because at the end of the day, not only do you need to analyze it, you also need to execute those strategies. So I'm really excited to have him do some trades together, look at some opportunities, and show you how to use the Tastyworks platform to potentially execute these strategies. So with that, I hope that those of you that are currently on a free trial consider supporting us and allowing us to continue doing this. Membership is just $75 a month or $500 a year to allow you to have access to all the tools that we have, the platform that I just showed you, access to the daily play trade ideas, the weekly education, the Tuesday and Friday morning market outlook sessions, the credit spread reports, all of these things that we're continuing to build and improve on to help you with your trading. So at this point, what I'll do is I'll open this up for Q&A. There's a Q&A window and there's a chat window. Please, if you have a question, please type them into the Q&A window. That's where I'm going to answer questions out of. I'm not going to answer out of the chat window. So please, there's a chat window and a Q&A window. Please type your question into the Q&A window for me to answer your questions. So Wallace is saying, your webinars are very informative, wonderful. I always look forward to Canada and Thursday afternoons. The markets have been very volatile this week. I was not able to get into your daily plays when published. They have now moved away from original entry price. Would it still be a good idea to enter Baba and Apple? I don't think it's a good idea to enter those trades right now. They were last week. Markets are vastly different from last week, so I don't think it's a good idea to enter those trades now. I do think the market momentum has shifted. That's something I'm going to talk about tomorrow morning, so please join me tomorrow morning for that session. Thank you very much. It's surprising that the term risk off means more. Probably a language issue. So risk on, risk off is what we typically refer to. Risk on is markets are okay and they're moving higher. Risk off is markets are stressed and they're likely going to sell off. That's what we mean by risk on, risk off. Wayne, the risk on, risk off is a great question. I was wondering about that. Is the 3-month VIX just looking back to the VIX chart 3 months ago and comparing it today? No, the 3-month VIX is looking at SPX 3-month options and the implied volatility of the 3-month options versus the implied volatility of the 1-month options. They're both forward-looking. They're not backward-looking. The problem with options is I am against theta, delta, wide spreads, gamma, vega. That sounds more like a statement than a question. If you don't mind, I'm happy to answer your question here. I paid for, now I can't log in. If you have login questions, please email us at info@optionsplay.com. I'll send you that link in the Q&A session. What about credit spread strategies? So that's actually something that I have a whole separate webinar on. Please, for those of you, you can also follow us on YouTube. I have previously recorded sessions on credit spreads if you want to learn more about those, but I will have one coming up here. If I'm not mistaken, in October, we will be covering credit spreads, but please follow us on YouTube, youtube.com/optionsplay. I do have videos here just on credit spreads that are actually recently recorded. So please take a look at that. I have several cover calls in my holdings, and I've been rolling them in August and September. Is it advisable to close these positions after quarter end or before earnings. We generally advocate for closing cover calls before earnings. Contango is when traders have greater fear in the near term versus further out in time. That is correct. If I am wrong, I sure hope TZ will correct my understanding. I think everyone here has the correct understanding here in my opinion. Wayne, if you have OptionsPlay through your broker, that does not give you access to Daily Play. Daily Play is only for our members of direct subscribers. Backwardation is when the current price, I'm sorry, backwardation, not contango, is when the front month is more expensive than the back month. So when we see the front month VIX is higher than the 3-month VIX, that means markets in the short term are stressed, and that is what we consider more of a risk-off environment. That has not triggered at the current moment. That is something we're going to look at tomorrow morning, so please join us tomorrow morning for that. For debit spreads, if calls are in the money, if short option call is exercised, does long call get exercised by broker? So for the short call of a debit spread to be exercised, then the long call is going to be in the money. So it really depends on your broker as to how they handle that. Each broker is going to be a little different. Some brokers will automatically exercise your long call for you. Not everyone does. So I do recommend that you call your broker and ask them that question. What does the curve represent? I think the question is, what is this curve? The curve here represents. The curve represents what is the value of the option going to be, and with respect to the change of the underlying stock price today versus the hockey stick line is what it will look like at expiration. I have option picks from Schaefer's that I haven't started using yet because I've never live traded before and want to open TFSA trading account for options trading. Should I use? So, I mean, you're asking me about tax advice, and unfortunately, I'm not a tax expert, so it's really difficult. I'm not going to, I really don't know, you know, which account you should open from a tax perspective. You really need to talk to a tax expert on that. Tony, can you give us a dry run on the platform? So Archibald, I actually just recorded a platform walkthrough earlier today, so we'll be launching that here in the next couple of days. But you can also follow us on YouTube, and I have a platform walkthrough on YouTube. I have watched your videos on YouTube on which trading platform in Canada I should use. Is the TD investing is the easiest? So, you know, Tanya, also, you know, as far as what broker you use, that's also not, you know, those are your personal decisions as far as which broker is best suited for you. There's a lot of things that you need to consider in terms of selecting a brokerage firm. So if you want, send me an email at info@optionsplay.com. I'm happy to try to provide some thoughts there. Is a spread called two legs? Yeah, a spread is generally considered a two-leg strategy. That is correct. Michael's saying, I would like you to explain how to find and understand Greeks in the OptionsPlay website. Yeah, so for any strategy that you type in, if you click on the blue share button at the very bottom here, it'll say explain strategy in Greeks. That's where you can find all the Greeks of that strategy. Does OptionsPlay have a paper trading function within its platform? We sort of do. So for any strategy that you want to follow, let's say you want to follow this debit spread here on ConocoPhillips, you can click on the blue button, and you can actually click on this link here that's actually allows you to copy or save a trade here. And once you copy or save a trade, it gives you a URL that you can use. We built it so that you can share the trade with a friend or share it with someone else or post it onto social media. But once you click on share a trade, it shows up in your profile under share trades. So you have a history of all the trades that you have shared. You can click on the link and it will bring up the trade that you saved for yourself. And this function actually tracks the P&L of the trade. So right now the trade is P&L 0 because I just saved this trade. But if I open this tomorrow and the stock has moved lower, I should see a positive P&L here. So that is one way that you can paper trade using OptionsPlay. Retirement accounts don't allow spreads. I think you can make them via individual legs. Would you advise this or have a different approach? I would not advise you to trade spreads as two individual legs. You have execution risk. It is, I would not recommend it. I think that if you can't trade spreads, either open an account where you can trade spreads or don't trade spreads at all. I don't advocate that you break them up into separate legs. How do you know the spread will be the same on exit as entry? I'm not sure what you mean by that, Ed. First of all, when you exit a spread, you should choose the legs that you own and click on close so you know that you're closing the legs that you own. That should prevent you from doing anything wrong, in my opinion. Since most spreads never reach the 100% profit, what do you suggest using as a target profit? So Ronald, that depends on what type of spread you're talking about. If you're talking about a credit spread, yes, rarely do you reach 100% profit. But if you're talking about a debit spread, it is fairly common for a debit spread to reach 100% profit. We usually say that you want to start taking profits about 75 to 100% gain on a debit spread. As you can see in plenty of the examples I showed you, you're looking at 156% return. So even if you don't get there, even if you only get to 100% return, you want to start taking profits at about 75 to 100% gain. Mark is asking us to explain the OptionsPlay score. Great question, Mark. The OptionsPlay score was actually inspired by poker players, because if you think about each options trade the same way that a poker player thinks about a hand, you're really calculating what is my potential reward versus my potential risk, and whether or not the potential reward is worth taking on given the risk that I'm taking. So the same way that a poker player calculates what is my potential reward, what is my potential risk, and what is my probability of success, those are the three things that go into a poker player deciding whether they want to play that hand or fold. That's how we created the OptionsPlay score. And what it tells you is whether the risk to reward is skewed in your favor, whether there's no favor or there's no edge at all, or if it's not favorable to you at all. So it's color coded for you. Red means that the risk to reward is skewed against you. Yellow means that the risk to reward is on average, and green means the risk to reward is better than expected. So that's how we created the OptionsPlay score. Bill is saying, I'm surprised that when you look at probabilities in your chart, they are very often 30 to 40%, and yet they give a good score for the trade. Is this normal? So what Bill asks is a really great question that I think many beginners don't quite understand about options trading, because all options trading is a trade-off, between probability and risk to reward. So you can either have high risk to reward with low probability, or you can have high probability with low risk reward. Unfortunately, most beginners, what they don't realize is that there's this relationship, and all they ever do is seek high probability, thinking that if I have high probability, I'll be better off if I just win more often. But the reality is that when you choose high probability trades like this, if I choose something like this has a 66% probability of profit. Doesn't that sound great? That certainly sounds better than 40%, right? But guess what? I'm risking $178 to just make $22. So yes, you'll win 2/3 of the time, you'll win that $22, but that third time that you lose $178. Does that play out in the long run? The answer is no. So don't just look at probability. Probability on its own means that if you're only looking at probability, that means you've lost track of the other half of the equation that's arguably more important. What you want to do is look at how well balanced the probability and the risk to reward is. And that's what the OptionsPlay score is telling you. And that's why the OptionsPlay score on this one is so poor, because despite having a high probability, the risk to reward is terrible. So don't just look at probability, look at the combination. And arguably, looking at the combination is hard to do. That's why we created the OptionsPlay score. What happens when you enter the legs of vertical spread as separate trades instead of a combination? Nothing happens. It's just that you have execution risk, and your broker will likely reject one side of the trade before the other one, because you can't enter the short side before you enter the long side. So you have to enter the long side, then execute the short side. You have a lot of execution risk where you can get filled on one side and not on the other, and you're taking on a substantially different risk profile if you don't get both leg fills at the same time. So I do not advocate that you split up a vertical spread into two separate trades. Find a broker that allows you to trade multiple legs, or don't trade multiple legs at all. Do we need to worry about assignments? So when you're trading debit spreads like these, your risk of assignment's pretty low. And even when you get assigned, you can always exercise the long leg to satisfy the assignment on the short leg. So generally speaking, with debit spreads, that is not something you need to worry about. What is the probability that a spread will expire worthless? Should I hold them to expiry? No. With spreads like this, you should almost never hold them to expiry. Well, generally speaking, with most option strategies, you should never hold to expiry, with the exception of maybe a cover call or a short put. Generally speaking, our rule of thumb here is whatever you pay for the debit spread, you always want to exit at about 50% loss. If the trade goes against you, you've lost 50% of the premium that you paid. That's usually a good time to start scaling out of the trade and moving on to the next trade. Hi Tony, with the call debit spread, what about buying in the money calls and selling at the money? Buying in the money calls and selling at the money when stock pulls back to fairly solid support, as opposed to buying at the money and selling out of the money. I know it might cost higher, but also increase the probability of profit. Barry, I'm not sure I fully understand your question, but let's look at Apple here as an example here. You're saying that I should buy the in the money call and sell the at the money call, something like this. So, I mean, if that's the case, then you're better off just selling a put credit spread. I don't think you want to sell, I don't think you want to trade a call debit spread. If you want to trade something like this, you're better off selling the put credit spread, which gives you the exact same risk profile, as you can see here. Exact same risk profile. The reason that I don't advocate that you buy sell the 114 call option here, the at the money call option, is because now you have a call option that's in the money, and you're increasing your assignment risk on that short call. You can do it. There's nothing to say that you can't do it, right? And at the end of the day, that's the beauty of options. There's so many different ways that you can utilize options. And Barry, you might prefer trading in this particular strategy, but I would certainly prefer trading the put credit spread rather than the call debit spread here. That's my personal opinion. But as you can see, the two risk reward ratios are almost identical. So it's just a matter of preference here. But you absolutely can do this if you would like. I just don't think it makes a lot of sense, because as the stock moves higher, you're short a call option that is now in the money. That increases your assignment risk, and that's why I would prefer selling the put credit spread. Victor, please discuss assignment risk if stock moves quickly and short leg goes in the money. So, your assignment risk on a debit spread is really low. So let me go back to the regular spread here. So you're saying that if the stock shoots up through that 124 strike, what is your risk of assignment? If you're not holding it in the last week of expiration, your assignment risk is virtually zero, because there's no economic reason for anyone to exercise a call early. You lose money if you're assigning a call early. You don't want to lose money. No one wants to give away free money here. So that's why if someone wants out of the trade, they're much better off selling the call option rather than exercising. That's why assignment risk is not something you really should be worried about in these types of strategies. What are some ways to save some of the trades that go the wrong way? Stan, this is something that I also talk about heavily, and this is something I plan on discussing quite a bit in my session here on next Thursday, Psychology of Being Profitable. This is what I find a lot of beginners do, is they spend all this time trying to prevent small losses. But ironically, when you, in the attempt to prevent your small losses, your trades that go the wrong way, that's usually how most traders blow up their accounts, is they're trying to say, okay, a trade went against me. What can I do to adjust it? What can I do to prevent myself from taking this loss? And they make adjustments and they do things. Next thing they know, they're risking more money, and they get themselves into a bigger hole and a bigger hole and a bigger hole until they blow up their accounts. The reality of trading is that you're going to have losses. There's no way you can prevent losses. And there's no magic bullet that you can just somehow make losses go away. If that was the case, everyone would be doing it. But that doesn't work that way. What you're much better off doing is accepting the fact that 30–40% of the time you're going to have losing trades. Accept that. Take that loss. Move on to the next trade. Spend your brain cycles, spend the time worrying about your winners, protecting those winners and turning small winners into big winners. Spend your time working on those types of problems, not preventing small losses. Once you have a small loss, understand that some trades are going to be losers. Get rid of them, close them out, make sure that they stay small losses, and keep them that way. Unfortunately, I see so many traders that have a small loss and they try to make adjustments. You know, they try everything they can to prevent that small loss. They say, oh, what if I just do this and I can get myself back to break even? Next thing they know, the thing that they do to try to get themselves back to break even puts them into even a bigger loss. And at this point, you start getting a little desperate. You try doing different things. And that is how I see so many beginners blow up their accounts. So Stan, as much as I would love to help you with some magic bullet that can just erase your losses, the reality is that that doesn't exist. If it did, everyone would do that. So I really hope that you join us here next Thursday as I discuss just the psychology behind how you should be thinking about your losers, how you should be thinking about your winners, and where should you spend your time. And I can tell you, it's not on managing small losers. It's on how to manage your winners. That's how you can turn a trading account around from these kind of frustrating, I would say, exactly, Ken saying be infinite. And this is something that I teach. It's, you know, trading is an infinite game, not a finite game. When you're so focused on each individual trade, the finite game, you lose picture of the big game, which is the infinite game. So that's something I'm going to talk about next Thursday. So Stan, I hope you're able to join me for that. Bob, can you please explain how to close out a vertical spread? So Bob, each broker is a little different, but most brokers, what you can do is you can go to your positions tab. You should be able to select both legs of your position, and there should be an option for you to close. If you can send me an email at info@optionsplay.com, tell me what broker you trade with, and we can see if we can help you with that. But I suggest that you call your brokerage firm, show them that you have a vertical spread, and have them walk you through placing a closing order. What kind of time frame or how far out do you normally suggest for these types of trades? We usually go about 45 to 60 days out as a starting point for in terms of expiration date, Hitesh. Vincent is asking, if Tom comes back next week, does that mean we'll finally have access to Tastyworks in Canada? So Vincent, you know, I've been connecting TMX, the Montreal Exchange, with Tastyworks. I've done everything I can on that front. It seems like it's just a matter of the inability for these guys to fly up to Canada and take the regulatory tests in order to launch, because right now the borders are still closed. So I don't believe this will be launching until those borders reopen, unfortunately. Tony, how come the numbers on your OptionsPlay tool are different from mine, even though the trades are the same? I don't know. If you want to send me an email at info@optionsplay.com, I can guarantee you that if you're looking at the exact same trade with the exact same prices, you'll see the exact same scores. If I'm bullish, when is it appropriate to do a debit spread versus credit spread? Joseph, I also have a whole nother video on this as well. Follow us on YouTube. There is a video on debit versus credit spreads where I dive into this, but it really comes down to, you really should never be comparing debit versus credit spreads. They're two completely different strategies. They're made for completely different outlooks. So the question to you is not whether you should trade debit or credit spreads. The question is, how bullish are you on that stock? If you're very bullish, buy the debit spread. If you're not very bullish, you're a little bit bullish, sell the credit spread. What is a good trade-off in premium for time? I'm not sure what that question means, Ariel. What is a good trade-off in premium for time? If you could clarify, I'm happy to answer that question. Please show me how to do a credit spread. So I have a whole series of videos on credit spreads. Follow us on YouTube, search for credit spreads OptionsPlay. I will show, we have videos recorded on that already, but I will do another session on credit spreads next month. So please join us in October for that. What makes you decide on a debit spread versus a credit spread? That was just a question that was answered before. The question is not whether I want to trade a debit or a credit spread. The question is, how bullish am I on the stock? If I'm really bullish, that's when you want to buy the debit spread. If you're not really bullish, you want to sell the credit spread. Where can I find all the previously recorded sessions? They are all on YouTube, so follow us on youtube.com/optionsplay. What are your thoughts on buying a Visa put, buying a put versus buying a bear ETF? Oh, sorry. What are my thoughts on buying a put versus buying a bearish ETF? So bearish ETFs are only designed to give you the inverse move over a single trading day. So if your belief is that the stock, if you want exposure over a very short amount of time, you might be better off buying that bear ETF. If you're looking for exposure over a longer period of time, buy the put option. Can you explain to me what factors go into calculating the options play score? That's something I already covered here earlier. Is in a credit versus debit spread strategy, is there any chance of getting a position put or call to you? With any option strategy, there's always the risk, but keep in mind that with any of these spreads, they're defined risk strategies. Even if you get assigned on the short leg, they're still defined risk strategies. So don't let that prevent you from getting into these trades. If you do find yourself in a position where you got assigned early, simply exit the trade and get out of the trade. If you got assigned early on a trade, that means the trade has gone against you. So just close out the trade and move on to the next trade. Just getting early assignment is not a good reason to be scared, because the early assignment doesn't change the risk of the trade. Why your platform never shows credit put or credit call spreads? So RL Matt, we actually have a whole credit spread report for you. If you've logged on to OptionsPlay, at the very bottom is our credit spread report. That's how you can see credit spreads that are scanned for you. Catherine is saying, thank you. Is there a way to find straddles or strangles or a specific strategy using OptionsPlay? Yeah, you can click on modify. You can use our strategy constructor. You can use straddles and strangles. I'm actually working on a straddle report right now for people who would like to sell straddles, to find which stocks have the highest premiums for selling straddles with the highest IV rank. That is something that we are currently working on here at the moment, Catherine. Can you please touch base on Apple put? That was Monday's suggestion. So Ned, that's something I plan on covering tomorrow morning, but Apple certainly has reversed course here. I do think that it's time to potentially cut losses on that trade. How gamma risk will affect debit spreads? Gamma on the debit spread is fairly low because you have a long and a short leg. You're certainly long gamma on a debit spread, but you're not as long as then if you're long the call option. But your gamma risk on a debit spread is fairly low, especially if you're not holding it to expiration. So gamma is not really something that we are generally that concerned about when we're trading debit spreads. What's your take on Etsy after it's included in S&P? I don't have a strong view here on Etsy. Etsy is certainly a stock that has really taken off after the coronavirus. Do I think that's going to last for a long time? I don't particularly think so. I think it's more of a short-term play here. When are you going to have your next webinar series for beginners? So Ronald, this is a beginners option series. We just finished one in August as well. So I don't think I'm going to be doing another beginner series for a while. October is going to be more of the intermediate stuff. So if you missed out on that, please go to our YouTube channel. We have a playlist for all of our beginner videos. Please watch that on our YouTube playlist. Can we analyze cover calls and cash secured puts in OptionsPlay? Bill asked. Absolutely, Bill. When you click on the income tab here on the upper right-hand corner, we will do the same thing for cover calls and cash secured puts. We actually select the expiration date and strike price for you automatically. You can create your own income settings. So for calls, you might want to use medium-term optimal. For puts, you might want to use short-term aggressive. Whatever setting suits you best, save this as default, and whatever symbol that you type in, we will scan for the optimal cover call and short put for you. And we also provide you with yield analysis so that you can see how much yield you're getting for the cover call or cash secured put, Bill. We also have cover call and short put reports that are emailed to you and updated every single day. So those go out around 11 a.m. every single morning with the most updated cover call and short put reports for all the S&P 500 and liquid names in the market. So Bill, we have a lot of cover call and short put strategies for you. Balu saying, please show how to enter your modify criteria into the trade panel. Oh, I'm not sure what you mean by how to enter your modify. So you click on modify and you can choose your expiration date, your strike price, your quantity, buy, sell, and call put. And you can also use the strategy constructor to construct any option strategy that you would like. To find weekly options, can you modify date in the options grid? Yes, absolutely. You can click on the expiration date and we'll show you which ones are weeklies, which ones are monthlies. These are all available to you here on under the modify grid. Ariel saying, is there a percentage or ratio you use as a rule of thumb trying to figure out the value of buying time? I'm not sure I understand. Oh, I think you're saying like, I think what you're saying is that if this put option costs $6 for a $120 stock, you know, $6 out of $120 is basically 5%. So I would say most blue chip stocks, you know, we want to stay under about 5% in terms of a, you know, 1 to 2 month call or put option. But, you know, it really depends on volatility, right? So if we look at Tesla, you're going to have to spend closer to 10%. If you look at Walmart, you might be spending only 4%. So it really depends on the stock, but I would say 4 to 5% for most normal blue chip stocks. You know, as you get into something a little bit more volatile, 6, 7, 8%. And then when you get into really ridiculous stuff, it gets into the 10 or 12% range. That's the general ratio that we tend to find. Is there a good time to sell cover calls for Apple? Arguably, any time's a good time to sell cover calls. Cover calls is a strategy that you can utilize at all times because we always use delta to choose our cover calls. We always choose a call that has roughly about an 80% chance of expiring worthless. So it doesn't matter whether bullish or bearish, we're always selecting a strike price that has about a roughly 80% chance of expiring worthless. So timing is not as sensitive for cover calls. Your view on TQQQ options. You know, I don't like trading any of the inverse or leverage options because you're basically trading a derivative on a derivative. You know, that gets really dicey. It's really hard to understand exactly what your expected return is going to be. I think you're better off trading just the calls or puts on the Qs themselves. I don't think there's a real reason for you to need to leverage your calls and puts. Do you prefer to trade near the money or further out of the money? Trying to understand best way to manage risk to reward. We would almost never trade an out of the money option in terms of if you're talking about buying. We'll always buy a slightly in the money option. This is all meant to prevent time decay or reduce time decay here. We never buy an out of the money option. I want to know how to do the spread on the platform. I'm not sure what you mean by you want to know how to do the spread on the platform. I think that today I showed you quite a bit as far as how to utilize spreads. If you don't mind clarifying, that would be great. Anne is asking, hi, Tony, the data in the chart is 1 day behind. So Anne, it's not that it's 1 day behind, it's just that after the close, we wait for the final print to come in before we process it. So during the day, you always have the real time, the live candle here. It's just that at the end of the day, after the market closes, at about 5:30, 6 o'clock is when we process the last trades, and then we put in the final candle here for today. How do you compare historical versus implied volatility in setting up debit spreads? This is something you can show on OptionsPlay. So we don't compare historical versus implied volatility. We do look at IV rank sometimes, and this is something that we'll be adding to OptionsPlay because that's really what we're looking for. Comparing historical and implied isn't really a good metric for looking at volatility. What you're much better looking at is implied volatility compared to its own history. You don't want to look at historical versus implied. I'm not sure where the whole historical versus implied thing ever got into, people's head that should be a way to compare that should be a way to look at implied volatility. What you want to compare is implied volatility to its own history. That's what IV rank does. So when you look at the liquidity spreadsheet, you have a metric here called IV rank. IV rank tells you how is implied volatility currently compared to its last 1 year history. When you have a very low IV rank, like we have on Home Depot, that means the current implied volatility of Home Depot is relatively cheap compared to its past year. When you look at something like Tesla that has 62% of IV rank, that means the current implied vol is relatively expensive compared to the last year. So that's a much better metric to determine whether the implied volatility in an option is cheap or expensive. You can use that on your liquidity link at the bottom of your OptionsPlay tool, which you can find here at the bottom of your OptionsPlay tool. Balu saying, all the simulation screens show the max loss at 100%. I think that was wrong. I'm not sure what you mean by the simulation screen show the max loss as $100. If you don't mind sending me perhaps an email at info@optionsplay.com, I'm happy to take a look at that for you. Doug is saying, how does the change in IV affect the decisions for buying or selling calls and puts? Doug, the thing about the change in IV is that IV is a very generalized term. First of all, there's an IV for every single strike and expiration date. So most people, when they refer to IV, they're not necessarily referring to the IV of each individual strike or expiration. They're talking about some generalized view of IV. Usually that's some kind of 30-day volatility metric. So first of all, IV is a generalization. That's the first thing you should understand. The second thing you should understand is that just because IV is low doesn't mean it can't get any lower. Just because IV is high doesn't mean it can't get any higher. So, but the general way that people use it is that if IV is low, you're better off buying options. If IV is high, you're better off selling options. Now, as a generalization, that's generally true. But again, there are a lot of caveats about that. So I hate to make these types of generalizations sometimes because some people who aren't as familiar as to how these things are calculated take that as kind of the holy grail, and they do make every decision off of that without really understanding the ramifications of it, which is why I always hesitate to say, oh, go buy options when it's cheap or go sell options when it's expensive, just because there are a lot of other things that go into that decision-making process. But that's the general thought process. When do you close a position? Great question. It depends on the strategy, but generally speaking, each strategy has a set of rules as to when to take profit, when to cut losses, and some strategies even have an expiration date. Once you get to a certain number of days to expiration, doesn't matter whether you have a profit or a loss, get out of the trade. So it really depends on each strategy. We do have most of those rules on our webinars, so if you watch any of our webinars on any of the strategies, you'll be able to see those rules. Wouldn't that be the ideal scenario for debit spreads that both strikes expire in the money to be exercised or assigned? I'm not sure why you would find that to be the ideal scenario, because the whole point of debit spreads is to not trade the stock. If you get assigned, I don't see why that would be the ideal scenario, Boris. What does the technical score mean? The technical score is a relative strength ranking. So as you can see on our watch list, or even on the trade ideas, you always have a score. That's the relative strength of that stock or ETF. So this ranks, so for example, when we look at the score, as you can see, energy has a score of 4, technology, materials, and consumer discretionary have a score of 9, telling me that these 3 sectors are the strongest sectors in the market, and energy is the weakest sector in the market. That's what the technical score is giving you a ranking of, is how strong the stock or ETF is compared to the overall market. Al, your question regarding different numbers, please send me an email with exactly what you're seeing, and I'll show you that they are the same. Perhaps we have different pricing that we're looking at. Is there a way to participate in shorting a stock with a regular, so I don't know, John, to your question about a TFSA trading account. I'm not sure what that is, but I certainly don't think you can short a stock without margin. Bill is saying the current Kiplinger magazine has a great article in comparing brokers' platforms. So thank you, Bill. Please do a trade on the platform for a credit spread. Sure. Let me flip to the Qs rather. If let's say I'm bullish here on the Qs and I want to sell a put credit spread, you click on modify, bullish, you short put credit spread. You know, the stock's at 272 right now, so maybe I would sell a 272 to 62 put spread, something like that. Collects $392 on a $10 wide credit spread. That's how you can utilize OptionsPlay to set up a credit spread. James is saying, a previous listener's questions about being in the money. I believe that if your short position is in the money by 1 penny or more, the OptionsPlay Corp does it automatically. That's only at expiration. Prior to expiration, you will not get a sign. So only at expiration. Joseph, you're very welcome. What is it called if you're bullish and buy leaps, buy, call, and sell the same price? I think you're referring to either a calendar. I'm not sure, James. If you can clarify, I'm happy to answer that question. When do you close your trade? Until expiry or when you're in a negative position? There's really no positions in terms of options that you hold to expiration, with the exception of maybe a cash secured put where you want to get assigned. You almost always exit a trade prior to expiration. If I enter a spread with a limit as opposed to as two separate legs, is it possible I receive less for the asset than I want to decay and pay less for the long asset to get the same spread? If you enter a spread with a limit order, that's the worst price that you'll get. It doesn't matter how you get filled on both legs. Sometimes you get wacky executions on both legs, but the net order, the net is the only thing that you care about. So don't worry about the individual legs. Just worry about the net for the two for the two legs together. In your platform chart, you have two support and resistance level. Can you explain why you have two of each? Just so that you know that if it breaks one, you still have another one. It tells you the two closest support or resistance levels. Owning a stock has a 50-50 probability, yes, 50% up or 50% down. If you look at the actual distribution of stocks, it's not an equal distribution, certainly not even normally distributed. So I wouldn't say that's a 50-50 distribution. The markets on average are up, over the long term about 55% of the time and down about 45% of the time. So right off the bat, you have a 55-45 distribution. But if you look over the past couple of years, this is skewed closer to 60-40. So no, I would not assume that you have a 50-50 distribution. How does the score of the ideas relate to the probability on the platform? The score does not relate to the probability. The score of the ideas is simply telling you the strength of the stock compared to the overall market. If you are looking for short opportunities, you generally want to see something with a low score. If you're looking for long opportunities, you generally want to see something with a higher score. Does OptionsPlay support index options? So currently we do not, but we just signed a new deal with NASDAQ. So we will be offering NDX here in the next couple of weeks. So you'll be able to trade all the NASDAQ 100 index options, NDX and NQX. And we also have an education event coming out in October. Really looking forward to having that event live. Everyone here will get a an invitation to that NASDAQ 100 index option education event. We have some fantastic speakers lined up for that event. Do you have a video on assignment risk and how you would unwind a trade if assigned? No, because there's nothing to really do. If you get assigned, you just close out the trade. That's it. If you're short 100 shares of the stock, you buy 100 shares. If you're long the stock, you sell the stock. There's really not much more else to it. If you're long an option, say you owned a put and the equity comes out with earnings after the market closes, could you or would you trade the underlying stock in after hours knowing that you were protected on the short side? James, sure, absolutely. I mean, if you have the ability to trade after hours and you think that that's advantageous to your stock, to your options position, nothing stops you from doing that. Just understand that you're taking on more risk. I have leaps in June 2021. I thought you, after viewing your webinars, is there a way to sell calls and reclaim the loss of theta? If you can sell short calls against a long leap, right? That's called the poor man's cover call. Just understand that you are changing the risk profile of your trade. As long as you understand that, you can do that. Is the credit the max reward for a put credit spread? Yes, the credit that you receive on any type of selling strategy. You're selling a put, selling a cover call, selling a credit spread, selling a straddle, selling an iron condor. The credit that you receive is the max profit. Thank you so much, HH. Tony, could you have a session fully explaining how best to use all the features of the right panel with 3 boxes? So Balu, I actually have some recordings of that. If you go to our YouTube channel, I have one on a platform. Let's see. I have one for that. See if I can find it. We do a lot of videos. Oh, here we go. OptionsPlay, platform services, and market outlook. So I recommend that you watch that. We did go over the full platform in that video. So follow us on YouTube, find this video, OptionsPlay, platform, and services. I think that's what you're looking for. Barry, you're very welcome. Mark, today you shared an example of a call debit spread and a put debit spread. Do these legs always have the same expiration date? For a debit and credit spread, yes, you always have the same expiration date on both. Are they still called a call debit and debit spread if the legs have different expiration dates? No, that would be called a diagonal if you have a debit spread type strategy where the 2 expiration dates have different expiration dates. That's called a diagonal. Can you share a few points on advice on buying time? I'm not sure what you mean by that. If you mean buying time premium, time premium is the worst thing to buy. And, for those of you that caught the session with Tom Sosnoff last week, he says that he almost never buys options for that very reason, because time decay is working against him. That's why I use debit spreads, so that you're long the call and then you're short a call at the same time. That's the whole point, is to reduce that time decay. We almost never buy straight calls or straight puts because of that time decay factor. Can you explain how to roll an options position to a similar, so roll, I get this question a lot about rolling. There's nothing more to rolling other than closing your current positioning and opening up a new one. So if you're long let's say an October 100 call and you want to roll it to the the November 100 call, all you have to do is close the October one and open up a November one. If you do that in the same order, that's called a roll. But even if you don't do it in the same order, it's still a roll. A rolling is just closing your current positioning and opening up a new one. That's it. There's not much more to it. There's not much to show you or explain. You're just closing one position and opening up another. James is saying, so wise, Tony Zhang. You use up more limited mental psyche in trying to salvage a dog of a position. So what James is trying to say is something that I've been trying to teach, which is that when you have a losing position, a lot of times people spend a lot of emotional and mental cycles trying to fix that losing position. Rather, I always advocate, let that trade go. It didn't work out. That's okay. You're going to get trades wrong. Spend your time and your emotions and your efforts on managing your winners. That's where you can turn a small winner into a much bigger winner. But guess what? The best thing that can happen to you in a small loser is to potentially get yourself back to break even, maybe get yourself into a small win. But that's the best case scenario. And that is never worth it to take on more risk just to get there. You're far better off spending your time figuring out how to turn a small winner into a much bigger winner. And there are lots of opportunities for you to do that. So spend your mental cycle, spend your time and your emotions on managing winners, not your losers. Just let your losers go and move on to the next trade. Pradeep is saying, how about NDX call debit spreads, which is in the money? There's never an assignment risk. For example, the 9,800, 10,000 call debit spread. Can you show that using OptionsPlay to explain? Pradeep, if you don't mind, send me an email on info@optionsplay.com. I'm happy to help you better understand that strategy. I don't have quite enough time to go through that. I'm already running pretty late here on time. I'm trying to get through as many questions as possible. Bill is saying, in life, you're guaranteed two things, death and taxes. And as a trader, you get a third one, losses. And that is absolutely true. The sooner you can get comfortable with the idea that as a trader, you're going to have losses, the better you will become as a trader. If I sold Apple 110, 100 put spreads expiring tomorrow, Friday, tomorrow Apple goes to 105 and it gets assigned. You're not going to get assigned if you sold the put spread and the stock goes below your short strike tomorrow. It's only going to happen that if you sold the 110 well, you're saying that if you sold the put spread that expires tomorrow, first of all, I would never recommend selling a put spread that expires tomorrow. That goes against everything that we teach here at OptionsPlay. If you're going to do it, I can't stop you from doing it. But if last week didn't teach you that lesson, then unfortunately, you're just going to have to learn that lesson the hard way. Is there a way to handle the situation for small accounts, especially if you have a small account? You don't even have the ability to roll that spread into the next week. Don't sell, spreads that expire tomorrow. If last week didn't teach you that lesson, I don't know what's going to teach you that lesson. The reason that we sell 45-day options is so that when we have a bad week like last week, guess what? We're not taking on a full loss. We can roll that potentially into another trade. When you sell a 1-week option or a 2-day option or a 1-day option, there's no room at all. You're just taking on a loss and that's it. We really call it just picking up pennies in front of a freight train. You're going to get steamrolled at some point on that strategy. How important is IV rank in your option choosing process? Lawrence, it's not a huge part of our decision-making process. It's something that we take into account, but we certainly don't make trades off of that alone. And that's the part that I want to warn investors, because a lot of investors will simply trade just because a stock has high IV rank or because it has low IV rank without any real directional view or anything else. They just see, oh, high IV rank, let me go sell. Low IV rank, let me go buy. And I don't advocate that. I use OptionsPlay as part of Chaikin Analytics and the standalone OptionsPlay tool, and I get different scores for identical trades. So Chuck, I will say that if you look at after hours, I guarantee you they're the exact same thing. If you're looking at intraday, you're likely seeing slightly different snapshots. Thank you very much for the excellent teaching session and platform demonstration. Very helpful. You're very welcome. I mean premium cost for 1 month versus 2 months or 3 months. Ariel, I don't think that you want to make those types of judgments because things shift a lot, right? So what was relevant today is not relevant last month, is not the same as when it was in March. So I wouldn't want you to use those types of rules of thumbs and try to stick to them because markets are always changing. Those rule of thumbs never stick, in my opinion. You always have to account for what is the current market looking like. Ed is saying, what is daily play? Daily play is the trade idea that we send out every single morning to your inbox at 6 a.m. To your email inbox. Should we be buying time or measuring cost of time with premium? Should we be buying time or measuring cost of time with premium? I'm not sure I understand that question, Ariel. If you don't mind clarifying. In the score box, why do I see a logo versus a check mark sometimes? A check mark just means that it has the highest OptionsPlay score. A logo means that it passes everything in this strategy checklist. So that's the difference between a check mark and a logo. Could you please talk about time decay and how that affects trade management? Catherine, I have some videos on this session. I don't quite have enough time to really get into the details of that. I'm happy to. I do want you to take a look at buying versus selling options on my YouTube channel. Buying versus selling options. In that, I talk about delta, theta, and gamma. So look at the theta slide. That's the one where I talk about time decay. If you're very bullish on, say, QQQ, is it better to buy a debit spread versus TQQQ? You know, Jay, the answer to your question is I don't know. Simply because if you're very bullish on QQQ, how much is TQQ going to go up by? How much is the debit spread going to go up by? Compare the two, right? I mean, one has limited risk, one doesn't have a limited risk. I think your question is really more along the lines of how much risk do you want to take, not how much money can you make. I have an HC call at 282.5 expiring October 1st. Should I take my loss and move on? Depends on how, if you've lost about 50% on the call option, I do think generally speaking, as a rule of thumb, you might want to cut your losses. Okay, I'm really trying to answer as many questions as I can, but I have not, I've run out of time here, but I really tried to answer as many of your questions as I possibly can. Again, I really hope that you guys find this useful in helping you better understand these strategies, more importantly, helping you understand how to utilize OptionsPlay so that you can analyze these strategies and become self-sufficient in being able to find strategies, analyzing them, know what type of risk rewards you're taking before you place your trade, so that when you place your trades, you're confident in the trades that you're making. With that, thank you so much for taking the time out here this afternoon. I hope to see you guys tomorrow morning on the 9 a.m. session. Like I said, there's a lot of shifts in the momentum in the markets right now. Join us tomorrow morning as we discuss charts and understand how we're viewing this market. Thank you so much. Have a great evening, and I'll see you guys in the morning.